Welcome back to Bank and Balance. In today's video, we're diving into a critical issue that's not only shaping the Chinese economy but also impacting global markets: the crisis in China's real estate sector. This isn't just a domestic story, it's a global one, with ripple effects that extend from Shanghai to Wall Street and from Sydney to London. Why does this matter so much to you, as an investor? Because real estate is one of the largest sectors in the Chinese economy, contributing nearly 30% of its GDP at its peak. What happens in China doesn't stay in China, it sends shockwaves through global trade, finance, and investment. In today's video, we'll explore the current state of the market, uncover its historical roots, examine its broader implications, and discuss what the future might hold for investors like you. So, let's begin by looking at where things stand today. China's real estate sector is at the center of an economic storm, and the signs are everywhere. Developers that once symbolized the country's economic prowess are now struggling to stay afloat. Take Evergrande, for instance. This company was a global powerhouse, with developments across China and beyond. But today, it's a shadow of its former self, with over $300 billion in liabilities and a default that shook financial markets worldwide. And Evergrande is not alone. Country Garden, another industry giant, is also teetering on the brink. These companies represent the tip of the iceberg in an industry plagued by debt, oversupply, and declining demand. The numbers tell a grim story: declining property sales, growing vacancies, and a mounting pile of unfinished projects. What's driving this? One major factor is the oversupply of housing. For years, developers built at breakneck speed, anticipating endless demand. But now, we're left with ghost cities, entire urban areas filled with unoccupied apartments and storefronts. Places like Ordos in Inner Mongolia are infamous for their eerily empty streets, a stark reminder of what happens when speculative bubbles burst. On the policy front, the Chinese government is walking a tightrope. To stabilize the market, they've eased some mortgage restrictions, making it easier for first-time buyers to get loans. Yet, they're also wary of rekindling the speculative frenzy that led to this crisis. It's a careful balancing act, and the results are far from guaranteed. But this crisis didn't appear overnight. To understand the present, we need to take a closer look at how we got here. China's real estate story begins with its rapid urbanization. In the late 20th century, millions of people moved from rural areas to cities, creating an unprecedented demand for housing. This urban migration was accompanied by government policies that encouraged home ownership as a means of wealth building. For many Chinese families, buying property wasn't just a necessity, it was a way to secure their financial future. However, this demand also fueled speculative buying. Investors began purchasing multiple properties, not to live in them but as a hedge against inflation and a way to generate wealth. Over time, housing became less about utility and more about investment. The government, too, played a significant role. Local governments, reliant on land sales for revenue, incentivized developers to build more, often approving projects that far exceeded actual demand. The result? A property market that grew faster than the economy itself. But this growth came at a cost. As prices soared, housing became increasingly unaffordable for ordinary citizens. Families stretched their finances to buy homes, taking on mortgages they could barely afford. Developers, in turn, borrowed heavily to fund their projects, creating a house of cards that now appears ready to collapse. What does this mean for the global economy? For starters, China's real estate sector is deeply interconnected with other industries and economies. The construction boom drove demand for raw materials like steel, copper, and cement, much of which came from international suppliers. A slowdown in China's real estate market reduces demand for these materials, impacting commodity prices and the economies of major exporters like Australia, Brazil, and Canada. Financial markets are also feeling the effects. Many global funds have exposure to Chinese debt, either directly through bonds or indirectly through investments in Chinese companies and related sectors. As developers default on their obligations, the risk of contagion grows. This could lead to a broader financial crisis, reminiscent of the 2008 global financial meltdown. Consumer confidence in China has also taken a hit. With property values declining, many homeowners find themselves in a precarious position, holding mortgages on properties worth less than what they paid. This phenomenon, known as negative equity, reduces spending and stifles economic growth. For global investors, the risks are multifaceted. Beyond direct exposure to Chinese assets, there's the broader impact on global trade and economic stability. As China's economy slows, so does its demand for goods and services, affecting businesses and industries worldwide. Looking ahead, the future of China's real estate market hinges on several factors. One possible scenario is increased government intervention. Beijing has already taken steps to stabilize the market, but further measures could include bailouts for struggling developers or even direct purchasing of unsold properties to reduce oversupply. Another scenario is a significant market correction. In this case, property values would continue to decline, leading to widespread defaults among homeowners and developers. This could trigger a broader economic slowdown, not just in China but globally. Experts are divided on how this will play out. Some believe that China's centralized government and strong fiscal position give it the tools to manage the crisis effectively. Others warn that the structural issues in the real estate sector are too deep to fix without significant pain. For investors, the key is to stay informed and diversified. Monitor developments in China closely and assess how they might impact your portfolio. Consider diversifying into less correlated assets to reduce risk. As we wrap up, here's what you need to know. China's real estate crisis is a complex and evolving issue with far-reaching implications. Whether you're directly exposed to Chinese markets or simply interested in global trends, this is a story worth following closely. At Bank and Balance, our mission is to help you navigate these complexities with clear, actionable insights. If you found this video valuable, don't forget to like, subscribe, and share it with others who might benefit. Staying informed is the first step towards smarter investing.